Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
If you're setting aside money for a major purchase, you need a place to stash your cash. Savings accounts, bonds, and money market funds are all options to keep your money safe. But how can you maximise returns?
I want to know if we should lock in a rate before central banks start cutting. And in today's dumb question of the week, what's wrong with premium bonds? All right, let's get into it. So I have kind of a love-hate relationship with cash. I like money and I like seeing it in the bank account, but I know that over the long term, it's not going to do so well. And there's a huge opportunity cost for holding too much cash. Is this the dilemma we all face?
I think so, and I feel the same way. I've seen money in my money market funds and I think, oh, it's boring. But then when equity markets tumble, I'm really glad I've got that money stashed away in a safe form. Although, to be fair, I don't have much money in a cash-like form for that reason, which is that eventually you're going to pay the price in terms of cash drag. It's going to underperform massively.
I think it's fair to say we all need a bit of cash on hand. Certainly for an emergency fund, which some people think should be 6 to 12 months of your spending. That's uncontroversial in personal finance. You also have to know your own risk appetite, right? And if you're going to panic when stock markets crash, then you probably need to hold a bit more of this safe stuff of cash or cash equivalents, which we might come on to.
It's funny because cash is the unloved asset. Everybody slags it off because it doesn't have very high returns long term. But in fact, there are lots of scenarios where it does pretty well. If you have deflationary environments, then, that's great to hold cash. They are quite rare, to be fair. But overall, I think it generally is a part of everyone's investment toolkit and one that probably should be used more than people do at the moment.
It's probably underappreciated. When you look at some of the portfolios that people have designed to be able to be held for the long term with minimized volatility, often you'll see 20 to 25% allocated to short-term government bonds or cash.
Yeah, people don't often realize that's the same thing. If you have short-term government bonds or ST government bonds or whatever they use as an abbreviation, that's effectively the cash rate. So money market funds, short-term government bonds, they all taste the same. They all have the same risk and return. That's the kind of cash-like part of many investment portfolios. And if you look on things like portfolio charts where they talk about short-term government bonds, when you see that, just think cash in my country.
And those things, money market funds, short-term government bonds, actual cash in a bank, will all roughly track the rate set by the central bank.
That's right. Plus or minus a few basis points. And if it's a money market fund, they track SONIA, the Sterling Overnight Index average usually. But that's pretty close to bank rate, which is the central bank's policy rate.
So emergency funds, portfolio design where you want reduced volatility. But there is a third category where lots of people would need to hold cash. And that's when you have a known call on capital or an expense in the near future. Let's say, less than 5 years. Would that be the near term where it doesn't really make sense to take the risk of something like stocks?
Or even bonds. Bonds are volatile as well. And you don't want moves in the yield curve to stymie your planned expenditure in the near term.
And here you mean longer dated bonds, not these short-term ones we talked about.
Yeah, if it's like a 7 to 10 year bond or a bond fund that buys the whole UK gilt market, then the duration will be around 7 years, and that's quite volatile. So again, you don't want to risk your plans for the sake of extra volatility with a little bit of extra return potentially. So, equity is not going to work over a 5-year period because if you have a known expense, you don't want there to be a crash just before you need it. So moving into something safe like cash makes sense.
Okay, I think the best way to think through where we might choose to put our cash is to have a specific scenario. So let me throw one at you, Roman. Let's pretend we're in a power hour. Okay, I've just sold a business or sold a house or got some inheritance. And now I've got £500,000 in my hands. And what I want to do is buy a house, but I've not even started looking yet. I'm just going to go and view a load of properties around the country. Now, how long is it going to take for me to buy a house? maybe 6 months, maybe 18 months, who knows? What am I going to do with my £500,000 in the meantime?
Well, I certainly wouldn't take a lot of risk with it. So equities, I think, are out. Or at least if you are going to expose any of the money to equity, I'd just put a tiny amount into it. But really, safety here is the key. And probably something cash-like would be just the ticket. But the key thing here is much more skewed towards safety rather than return. So really what you mustn't do is lose money. And if you have got a return over that period, so much the better. But I wouldn't expect a huge return over that period because you're not going to be taking much risk.
Certainly, if you choose a product which is advertising a return significantly above the bank rate, the risk-free rate, as you might call it, then there's going to be risk somewhere. You just have to work out where it is.
Yeah, always. If the return is higher than the risk-free rate, just know that there will be some kind of risk somewhere. So if you are planning to spend that money over the short term, look around for something which is A, the best cash rate, B, it doesn't have any kind of liquidity constraints, because if you are tying up the money for, say, a 5-year fixed rate deposit, then you can't take it out without penalties over that period. So make sure that you're not essentially locking the money away so that you can't use it. And there are tax implications as well. So you've got to be aware of that too.
So let's go back to this specific scenario. Got £500,000. I don't know exactly when I'm going to need it. 6 months, 18 months, maybe. The first thing that comes to mind for most people is some kind of savings account, right? You go on Money Saving Expert and you find the savings accounts with the best interest rates. Now, usually you'll get a higher interest rate if you do lock the money up for a year or 2 years. In this specific scenario, it's hard to commit to that, isn't it? Because maybe you need it in as soon as 6 months if you find a house you like quickly and get an offer accepted. So presumably we're going to rule out those kind of fixed term deposits.
Yeah, I think that wouldn't work because of the uncertainty, like you say. So you're going to pay a penalty in terms of not locking the money away for a certain period of time. Usually you get a lower rate if it's a sight deposit. This is what banks call it, where you have access to that money at any time.
So one option would be to put the money in savings accounts. Now, we know that in the UK, we have FSCS protection, the Financial Services Compensation Scheme, which means that the government guarantees your money up to £85,000 per institution, effectively. So if we were wanting to be super safe, we would presumably look to split that 500,000 over, what is it, like 6 different savings accounts, if we were only looking at banks.
Which would be a pain to do. There are products out there which allow you to do that automatically. Maybe that would be something to look at, because it just makes the whole administration easier if they split it for you rather than you doing it. But there are other ways of getting a safe, steady return without taking a lot of risk. And these are money market funds. And I speak to a lot of people about these, and people are just flummoxed by them because I think the name's misleading. People think money market, what's the money market?
Yeah, it sounds like some sort of dodgy international transfer system where you're going down to the high street and your money ends up in Nigeria spent on mobile phones or something.
But in fact, it's a super safe thing because they invest in very short dated instruments, things like bonds, which are about to mature in your currency, or it could be commercial paper. These are IOUs issued by companies and they've got very high credit quality. And again, it's very short term stuff. Or it's things like certificates of deposit, which are deposits with banks, which earn a fixed rate of return. But importantly, these are very liquid instruments. So if you need to put the money in, take it out, you can do that very quickly, very easily. And it's also very safe. However, it won't come with the 85k guarantee. So if you're concerned about the institution going bust, personally, I've got very low worries about that because it's very unlikely. But certainly people I speak to do worry about that. So you're giving up that guarantee, but you've got something which is very, very safe and very liquid, and your money's not locked in for any period of time. However, you will be liable for tax on the interest that you earn.
As you would with a savings account that's not in an ISA.
Yeah. And for money market funds, it's worth saying that they'll all offer a very similar rate. A lot of them track SONIA in the UK. Elsewhere, they track the money market rate in their country. So in the United States, for example, it would be the SOFR rate, SOFR. And on average, that'll be a tiny bit above inflation over the long term. So you don't get much of a real return at all, if any.
And would you expect them to be a little bit above the rate you get from a bank? Because a bank's presumably trying to make a profit on you, whereas a money market fund is trying to make a profit, but a much smaller profit?
Yeah, I think the first thing to do, look up the SONIA rate at the Bank of England's website. And that's your target. If you can beat that, so much the better. But if you earn less than that, then the counterparty's skimming some of it off because they can earn that roughly.
Which is fair enough. Like, I want institutions to make a profit, or I'm thinking, are they running a charity? There's something going wrong here.
Yeah. So the first step would be look up SONIA, look at the rates which are out there, and try to find one which is comparable. And you'll see this kind of equality amongst different rates. You'll see that that's the upper limit, and other institutions get off you slightly less or considerably less. But it helps you make the decision in the first place on what rate to accept.
And unlike bank accounts, you would have few qualms with putting the whole 500,000 in one money market fund.
Yeah, personally, I don't have an issue with that because I think the counterparty risk is limited. But other people are more paranoid about that. So perhaps they would use more than one fund. But I don't think it's an issue. It's just that I'm familiar with the products and the market overall. It does have liquidity problems in extremis. For example, in the 2020 sell-off with the COVID pandemic, that was a period when money market funds wobbled. But the wobble wasn't huge. And of course, central banks really stepped in aggressively to ensure the liquidity was there.
That's the point, isn't it? These products are so key to the plumbing of the financial system. Like, everyone thinks of them as safe and that they will not lose money. And the central banks presumably can't afford for that assumption to be undermined.
Yeah, I mean, this is their key job, right? If people lose faith in money, and money markets are, to all intents and purposes, money, then they failed to do their job. And that's why they'll do whatever they can, and they can do a lot, remember, to ensure that money market continues functioning smoothly.
However, if you read the information documents that come with these money market funds, they will flag that this is a risky product. There is counterparty risk in there. If they've invested in commercial paper, one of those companies, even though they have very high credit quality and it's very, very short-term debt measured in days, one of those companies could fail.
Because Lehman was an issuer of commercial paper and it did fail. And that was a huge shock. And I think the primary impact actually was in that space. It was in the money market space. So it does go wrong sometimes, but you can see what's in the fund. If it's got a lot of commercial paper in it, then just look at the counterparty, see if you're happy with it. They have to be transparent, these money market funds. And it's not that hard to read through the list of things which they own to see whether you're happy with it or not.
I think if you start having a lot more cash, let's say you get up into the millions, then it becomes completely impractical to keep it at a bank and split it across loads, right? Then you really have to look at money market funds for sure.
Yeah, so there you'd be thinking about money market funds. Maybe gilts would be another way to do it because those are a very tax efficient way of parking money over the short term because you could buy a gilt that's about to mature. They're very liquid. You can buy in unlimited sizes and you don't pay capital gains tax in the UK on gilts. So if you choose a low coupon gilt, it can be a really safe store of value. But if you do sell it in the secondary market, let's say you suddenly find a house after a month of looking, it's the perfect house, but your money's not going to mature. Your gilt is not going to mature for another year. Well, you just have to sell the gilt and you may sell it at a slight loss, but that's the risk you take. But it's very liquid. You can sell it whenever you want. The loss won't be huge. If it's an about to mature bond, it'll be pulled to par. It'll be approaching 100. So the volatility will be ultra low anyway. So I don't think there's a lot of risk there either. That's another alternative, I think.
And to be clear on the tax treatment of gilts, the yield that you get, the yield to maturity, is kind of split into two components, isn't it? There's the coupon, which is your income, and you pay income tax on that. And then there's the capital gain. And here, gilts are treated in a special way, and you don't pay capital gains tax. So, like you say, if you choose a gilt which has a very low coupon, and there are lots of them because we had a period of zero interest rates, then most of the yield to maturity is going to be tax-free, even if you don't hold it in an ISA.
Yeah, so the yield curve is what, 4 or 5% at the moment. And if you're choosing a bond with a really low coupon, say 1/8%, then the remaining yield, the difference up to that 4 or 5%, is going to be capital gain, which is tax-free. And the coupons would be tiny. So if you had £1 million worth of a 1/8% coupon bond, then every 6 months you'll get a payment of £625. So it is tiny relative to the actual principal that you've bought. So the liability for tax would be tiny as well. So if that 1,250 came above your personal savings allowance, then you'd pay tax on it.
Yeah, maybe we should clarify that personal savings allowance. So everyone who's a UK taxpayer gets an allowance where they can earn an income from their savings and not pay tax. If you're a basic rate taxpayer, that allowance is £1,000 per year. If you're a higher rate taxpayer, it's £500 per year. And you lose it completely if you're an additional rate taxpayer.
But check when you hear this, because it might have changed. It does change year to year. So gilts, I think, are another option. And again, it's a thing which people are scared of because they don't understand them. But it's a really useful part of your investment toolkit. So it's worthwhile getting to grips with them. And, just don't be scared of them. Try a tiny little gilt trade just to try it out. It is a guilty pleasure.
Oh, every time, Roman. Got to come up with a new pun for gilts.
I can't.
But whatever you choose, these are all pretty good options, aren't they? A bank account, a money market fund, these short-dated government bonds, gilts, they're all going to be pretty safe and give you roughly similar levels of return. So you can shop around and pick your poison.
Yeah, if anything, there are too many choices and it's difficult to choose between them. Really, you've got to do it based on what your preferences are, what you're comfortable with, and what the rates on offer are. Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. As all good investors know, nobody can control what happens in the markets, but one thing they can control is their costs. That's why Saxo has lowered their prices so you can grow your wealth and more of your money stays right where it belongs, with you. Search Saxo, invest for less.
Okay, so we talked about how you might want to allocate your cash if you need it in the very short term, let's say in the next year. But what happens if you need it in 5 years? This is the kind of middle ground, isn't it? Where you don't want to put it all in risky assets for the reasons we've talked about, as in you might lose money just before you need it. And you're also thinking, well, if I just put it all in cash and get the risk-free rate, maybe I could do a bit better. And this is where we get the whole question of, should I lock in a rate? And what are the considerations there?
I think trying to guess what rates are going to be 1 year, 2 years from now is not easy, because one of the considerations is the period of lending and borrowing. If you look at the yield curve, for example, that is defined by how long the government's borrowing for, and the rates are very different and behave very differently according to where you are on that curve. So the short end of the curve is driven by central bank policy, which is not predictable because that in turn is dependent on what's happening to inflation, what's happening to unemployment.
What's happening in Greg's? Did you see the price of sausage rolls now? I saw it's like £1.40 a sausage roll or something. Let me check. Hang on. Yeah, it's like almost £1.50 a sausage roll. I remember when it was like £4 for a pound.
God, they're horrible. I just tried one because Laura's grandson loves them, and it was just rank. It's disgusting.
Try the vegan one. It's not so bad.
Yeah, I'll try that.
But anyway, we only mention it because Andrew Bailey, the Bank of England governor, once said in a press conference that he likes to get on the ground in bakeries to assess inflation across the country.
Which is laudable. So the short end is driven by those inflation concerns and also what's happening with the economy. If there's a crisis, they're going to cut that rate and you'll earn less if you're in a money market fund, because that almost immediately picks up the lower rate. And then you've got your 5-year rate or 10-year rate. And there you're moving into the longer part of the yield curve, where GDP growth and inflation expectations, those factor more into the yield that you get overall.
There it's not set by a bunch of people in the central bank, is it? It's set by the market and their expectations.
Yeah. And there are certain institutional buyers which have to buy that. There are all sorts of drivers of that yield curve. It's also to do with issuance and redemptions. There will be bonds which are maturing. The government's topping them up with new bonds. And if they're having to issue a lot of bonds, that can push up the yields, which can make them more attractive. So there's a huge number of moving parts here. And it's very difficult to forecast what the yields are going to be at any point in future. But roughly, if you just wanted like a really rough guide, the long end of the curve's 5%, short end of the curve's 3%, and that's normal, right? Okay, so that's based...
That's macroeconomics in a sentence. But this 5-year period is neither long or short. It's that intermediate, tricky length.
Yeah, so you've got the belly of the curve, so that's the kind of 5 to 10 year bit, and then 10 years beyond is the long end, maybe a bit further out, 15 to 30 year. That would be the long end. But that's the rough shape you'd expect when things are normal.
Because the obvious thing to do, if we need money in 5 years on the dot, I don't know what it would be, school fees, let's say, you need it in exactly 5 years. The obvious thing to do would be to buy a 5-year government bond, which will mature just as you need the money. You've locked in whatever that rate is on the yield curve at the moment, and that's guaranteed. But I think the instinct people have is that, maybe I can do better than that.
Yeah, you could do better than that, but it's unpredictable. So what you're giving up, if you don't lock in a rate, is certainty for a gamble that rates are going to go up. What might cause that to happen? Well, perhaps there's going to be an increase in inflation. Perhaps there'll be some other reason why the central bank would choose to raise rates.
But at the moment, it looks like we're heading in the opposite direction, right? People expect rates, at least at the short end, to fall. And presumably that would drag the belly of the curve down a little bit.
Yeah, so the belly would be affected much more than the long end of the curve, which is much more fixed by those growth and inflation expectations. So it isn't really predictable. And that's why I'd be a little bit cautious about trying to forecast what will happen at the 5-year part of the curve, because it won't be purely driven by the short end, plus any cuts will be partially priced in already. For example, as we make this recording, the Federal Reserve hasn't cut its policy rate. It's very likely to do that in September of 2024. But if you look at the 2-year part of the US yield curve, it's already falling, as are many of the other central bank 2-year yields, because they kind of price in this expectation. So I don't really think people have a special insight into which way it's going to go.
If they did, maybe they could run a hedge fund. But it's interesting, isn't it, that if you flip this and take the other side, so you say, I'm now a borrower, got a mortgage. Should I fix now for 5 years or should I wait a bit? Here, people seem way more willing to say, I should wait till rates fall, right? But it's driven by the same things and is unpredictable, like we've just said.
Yeah, here is the swap curve, but that's very similar to the gilt yields that we see in the gilt yield curve. So again, unpredictable. And I don't think that people should be making a punt on it.
But people seem way more willing to say they can predict where mortgage rates are going than they do about where gilt yields are going. Even though, they're very linked, right?
Yeah.
You look at all the analysis in the papers. It's like, wait to fix your mortgage. Come on.
I think that's right. And I think it's kind of unpredictable and people shouldn't try. But to be fair, yeah, it is going downwards. We are at the peak of a rate hike cycle. And so I think, saying it's going down is not a huge punt.
Priced in, Roman.
Priced in, yeah. So will it go lower than it is now? Yes, at the short end. But for the 5 to 10 year part, I'm not convinced there'll be a huge move from where we are today.
I mean, I was being facetious by saying priced in, but it's true. Like, if you're looking to fix your mortgage, for quite a while now, the 5-year fix has offered a lower interest rate than the 2-year fix because markets know that rates are most likely to fall over that period.
Yeah, and that'll affect the yield curve. And so it's all kind of self-referential in that sense.
It always makes me laugh when people think I can do better than whatever the gilt rate is for a certain period without taking on extra risk.
Yeah, don't try to be too clever, I think is probably the best motto in this case.
But if you were looking at this 5-year period until you need the cash, would you be tempted to mix in a dash of risk assets, a little bit of stocks or investment grade credit or something?
Yeah, I think investment grade credit wouldn't be a bad call because it isn't hugely crashy. So even in extremis, you're not going to make a huge loss. But equity, maybe not. That is more volatile and the size of the drawdowns could be larger. But a little bit of investment grade credit, I don't think would be an issue. And if you are going to put equity in, well, just think how painful a shortfall would be. If it's your daughter's wedding, then if she ends up having a happy meal instead of having a marquee, then you will not be a popular dad.
No, that's true. We were going to have this wedding in the Austrian mountains in like this huge chateau. We booked the chateau. It was going to be amazing. And then we're like, you know what, Roman? We hate people. We hate small talk. So we cancelled it. Just did it in the like local registry office in Islington, walked down there and then spent all the money on 4 honeymoons.
That's brilliant.
The family was not amused. And the ironic thing about me saying we don't like small talk is that somehow just you and I chatting have managed to make 100+ hours of audio over the last couple of years. Okay, well, let's wrap this up. Are there any other things that are kind of cash-like, which people like to hold money in for the short term, which we haven't covered?
Well, when I speak to people about, and they often say this as if they're kind of confessing something, is peer-to-peer lending, where there's some kind of platform where you can contribute a loan and essentially you're lending money to someone who you don't know and you're trusting the platform to ensure that the counterparty risk there isn't too great. So it's a little bit like going down to the pub and lending money to Dave, but it's happening via technology, so you feel as if it's safe. Now, that is risky. This is illiquid. So if you need the money and the market shuts down, you may not be able to get your money out. You don't know who the counterparty really is. The platform might claim it's a seasoned loan, but I wouldn't trust it. And it doesn't have a credit rating. It's not really something which is tradable, like a government bond or like a corporate bond even.
I feel like I saw these platforms being promoted so much like 5 to 7 years ago in the pre-COVID times. And now I don't hear so much about them.
And I think that's partly because of regulation. I think the regulators clamped down on it. Also, there was a big shakeout because there was a problem with credit and many of the loans did go bad. So I think that's why I'd be really cautious about peer-to-peer. It's not safe. It's not like fixed income. It's like a high yield loan.
The other thing I used to see promoted a lot was so-called mini bonds, where slightly unusual companies, maybe property developers, maybe a chicken shop, whatever, they would sort of promote to their customers that you can buy our bonds, and they promise high rates like 8%, 9% per year. And unsurprisingly, they were not safe investments. I'm putting it politely.
I saw that in London as well. When I was working in London, I used to see these, I think it was a sandwich shop, which was offering mini bonds. And I thought, oh, I know about bonds. And I looked it up and it wasn't a bond really at all, in the sense that it didn't have a credit rating. It was unrated. And really, it was just an IOU. So again, it was a bit like lending money to Dave down the pub. So really, you've got to be careful about these unregulated markets and just be sure that what you're buying is safe. And if it isn't traded on a regular exchange, if it's not regulated, then I'd stay well away.
Yeah, I know the FCA stepped in 2020 and banned the promotion of these mini bonds to regular consumers, unless they were, sophisticated investors or have a high net worth. Because so many people lost out by thinking, oh, my chicken shop's not going to screw me over. I'll lend them my money while I'm buying a variety bucket.
I think they did have a food offer that went with it, which I thought was great.
Yeah, so many things had that, like free popcorn or free boneless wings or whatever for the lifetime with a bond.
I'd prefer coupons. And another thing that people talk about is stablecoin. Now, what's interesting about stablecoin is that it buys a lot of the same stuff which a money market fund would buy. In fact, I just describe it as a money market fund in disguise. It's not very convincing.
It's not very regulated.
Yeah, and probably you'd be better off with a money market fund anyway. But that's how they achieve the safety. They buy short-term instruments and that keeps it safe and that ensures that there's liquidity as well if people want to pull money out.
I've no problem with stablecoins in theory. It's just, are they regulated to have the same protections that money market funds have? At the moment, I would say largely they don't. Are there any other assets people hold thinking they're cash-like? I suspect some people hold things like gold, even though that's not really suitable for a short-term investment.
The thing is, gold is so volatile. It's got equity-like volatility. So if you're worried about stocks because they might crash over the short term, you'd also worry about gold. And it's got its own weather, if you like, in gold. There are certain things which drive its price down, but it is inherently unpredictable. So I'd keep away from it if you've got liabilities over the short term, 5 years or less.
Yeah, it's one of those assets that if you don't really think about investing very often, can trick you. Because a lot of people think, oh, it's the kind of original, hardest form of money, the safest form of money. But that safety doesn't play out in a low volatility, like you say. It's crashy.
Yeah, and cash doesn't crash. And that's the important thing to understand. You can probably tell that the definition of safe is something that a lot of people are not clear about. And this is something which you could learn as part of our community, because we do discuss our safe investments, probably more than we should. If you want to join our community and discuss it with us, then just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, what's wrong with premium bonds? I get the feeling that a lot of our audience would have listened to all of our chat up to now and saying, okay, they're going to mention premium bonds next. Surely they're going to mention premium bonds next. What? You got through the whole thing and didn't mention premium bonds? That's where I put all my money.
Yeah, and I speak to people who do. And I have an issue with premium bonds, which is that I think the payoff is very poorly understood. And the yield is difficult to calculate because it is unpredictable. So I think if you're going to go for something safe, I'd prefer something safe and predictable.
You're not a gambler, are you, Roman? Come on.
I'm not.
Take a risk now and then.
Oh, no. When I buy a bond and I see those coupons guaranteed and they occur like clockwork, they pop into my brokerage account, it gives me a deep sense of connection with the universe. I love it.
Don't you think the FCA should be in there and say, you can't call these things bonds? These premium bonds. They're not really bonds. But anyway, let's talk about them because people like them. I would say, looking at the stats, they are by far the most popular savings product in the UK.
So let's just rattle through the key features of these things. The minimum investment is £25. Essentially, you're giving money to the government. So it's a cheap way for the government to fund itself. It's NS&I, which runs it, National Savings and Investments. One of the benefits is the fact that it's tax-free. The maximum holding is £50,000 per person. So there is a cap, which you don't have with gilts, by the way. Anyone aged over 16 can buy them. And effectively what you're doing is buying lottery tickets. So there's a prize range of between £25 to £1 million, and there's a monthly draw where they work out who's going to get the prizes. Now, every bond that you buy increases the odds of winning. So the odds of winning a prize are 21,000 to 1 for every £1 bond that you buy.
I don't like those odds. But let's talk about why generally they're not the most efficient use of your cash. So premium bonds will typically return less than actual government bonds, the gilts we mentioned earlier, and less than fixed-term savings accounts, even after you account for the fact that they're tax-free. So as we record this on the 12th of September, the mean annual interest rate for premium bonds, like if you have average luck, the mean rate of return would be 4.4%. However, the median, like the typical person, will see an interest rate of 3.5%. Now, obviously, you're going to get closer to the median the more bonds you have, right? If you have a very small number, it's going to be much more unpredictable. But the advertised rate is this 4.4% mean. Like any lottery, it's skewed towards the big winners. You could win $1 million.
And all of the cognitive biases that go with gambling go with these premium bonds. They're easy to market because you have these low probability, high payoffs, and you'll, on average, earn less than you would with something which is much more predictable, which is a government bond.
And my main issue with them is not even that, though. They earn a little bit less than government bonds, okay, but you might win this big prize. You're paying for the lottery ticket. But my main issue is not that. It's the fact that people hold them like they're long-term investments. So many people I see have like £50,000, the maximum, in premium bonds, and will hold it for like 30 years. Like, put that in equity and you would have been a lot better off. because you get a higher rate of return and it compounds.
But people love them. I just can't explain it.
It's an amazing product for the government because it also has that lock-in effect. Like lottery tickets, you think, well, if I realise it's not brilliant and I sell them this month, no doubt my numbers are going to come out next month. I got to keep buying tickets and keep giving the government this cheap capital.
Yeah, it's great from the government's point of view. In a sense, they're doing arbitrage on people's statistical knowledge and understanding of probability.
The thing I don't understand about them is if they are such a good source of cheap capital for the government, why have they got the £50,000 cap?
Yeah, perhaps they know they're defrauding their populace, so there's a cap on how much they're willing to do that. Perhaps there's some element of ethics here.
Oh, I thought it was more that they didn't want to incentivize people too much not to put money into risk assets. Like, we do want to grow the economy as well as fund the government.
But I think the other point is that the capital you put in is not inflation linked, which means that if you do keep it in for 30 years, your money will be eroding over time. So, I just don't find that attractive at all.
And I think people overestimate the tax benefit. So it is true that with premium bonds, you pay no income tax on those prizes you may win, or capital gains tax. That's not relevant here. But you've got to remember, in the UK, we have things called ISAs, which offer that same benefit. You don't pay income tax or capital gains tax, and you can invest them in whatever you want. But you might think, if I've maxed out my ISA, I've put in my annual £20,000 limit, surely then premium bonds are the place to go, because it's another way of getting tax-free income. But remember what we mentioned earlier, that in the UK, we also have a personal savings allowance. And it would actually take quite a bit of excess savings to exceed your personal savings allowance, especially if you're a basic rate taxpayer. So if you work through the numbers, at today's top savings accounts rates, a basic rate taxpayer would need to invest around £20,000 outside of an ISA to exceed their personal savings allowance. And below that point, premium bonds have no tax advantage for a basic rate taxpayer.
So for me, that would skew my preference hugely towards investing in, say, stocks in a stocks and shares ISA.
And remember, the ISA allowance is use it or lose it. So if you expect your income to be high in future years, claim your ISA allowance while you can. But having said all that, maybe there is one specific set of circumstances where premium bonds might just about make sense. Now, this is only if all of the following are true, can I see that maybe they do make sense. So if you are a higher rate taxpayer and have used your full annual ISA allowance and have exceeded your annual personal savings allowance, and you need to hold cash for the short term, and you're not comfortable with government bonds, these low coupon ones we talked about earlier, then premium bonds might be a good option.
Yeah, I'd go for the gilt.
Yeah, but we always say don't buy things you don't understand, right? And if you don't understand the gilt, the premium bonds will actually give you a pretty similar rate of return.
But would you understand the probability of the payoff? I just don't think that people do.
I think people understand gambling a little bit more than they understand investment, weirdly.
But as always, you should do your own research. And this is not investment advice. But I have to say, I hate premium bonds.
Yeah, but just because we hate them doesn't mean you shouldn't buy them. Some people love them. Just if it was me, I wouldn't put too much in them. Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.